Today in InvestTalk, we look at Tesla's potential $5 billion investment in xAI. We then look at the market ahead of Wednesday's Fed meeting. We answer questions about Take-Two Interactive, Intel, Target, and more. And near the end, I discuss the yen's impact on tech stocks.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today has to do with a potential investment from Tesla into Elon Musk's latest AI startup, xAI. And he asked on X, not xAI, on X, that should Tesla invest $5 billion into xAI, assuming the valuation is set by several credible outside investors. Now, here's the first issue with that, is that just like his pay package was shot down recently by courts, not because it was the largest in history, which it was, but it's because it was not approved by third-party board members, independent board members, that they were too tied into his other businesses, and they didn't have a clear-eyed view of this pay package because they were, tied up with Elon and other businesses, and that's been a history of kind of Elon's deal making. Is he does a lot of related party transactions that are questionable. And this would be another one of those, right? Where Tesla shareholders would be financing xAI, which is a new endeavor, really. It started last year, and July of last year. And the goal was to develop large language models to compete with Google, Microsoft, OpenAI, Meta, and others. And they produced their first product called Grok, but it is well behind ChatGPT and many of the others. Okay, which makes sense, right? It's a company that's been around a year and trying to build something that's very difficult and complex, and trying to compete with others in the space that have been doing it for many, many years. So that's understandable. And so the question here is, would this be good for shareholders of Tesla? I think of Solar City, right? So Tesla bought Solar City when Solar City was on the brink of bankruptcy, and that has been negative ROI, when it comes to cash flow and profits for that part of the business ever since. So it was kind of a wasted effort. And is this going to be another one of those failed acquisitions for Tesla? And they talk about a lot of these other aspects of Tesla, but none of them have really come to market with products that produce significant revenue. Even full self-driving, which has its problems. I saw another story recently about a full self-driving car, Tesla running into a parked police officer or police car, And so there's issues with that technology, yet they're still charging for it. And so there's a lot of questionable business practices within the Elon Musk empire. And this is another one that raises a lot of red flags for those that want to see good corporate governance across Wall Street. Okay. And this comes on the heels of a poor Tesla earnings report where their actual sales, automotive sales segment, actually declined. Revenue declined. So, really they're after some sort of growth. And, Elon's great at, he's a great marketer. He's great at spinning up hype and excitement over particular potential products. Robotaxi is a good example, which they continue to hype up, even though 5 years ago, Elon promised in a year there would be millions of robotaxis on the roads. But we haven't seen any of them yet from Tesla. So, he's starting to recycle some of this hype, but he's also playing on the hype around xAI, or just AI in general, right? And which makes sense. That's kind of his MO, is find the sexiest pitch and find a way to sell it to shareholders. And frankly, that's what Elon's been the best at across his empire, from the Boring Company to Tesla to SpaceX, etc. And, he takes a lot of swings. He has a ton of misses and he hits on a few. And obviously he relies on those few to really drive that next cycle. But we know that shareholders, they are not going to sit idly by and wait for Tesla to drive more growth out of the automotive sector, which is very difficult, not just for Tesla, but for a lot of the companies out there that have invested in EVs, including Ford, their recent earnings reports. You have Volkswagen, for example, going big into EVs, and they're pulling back. So it's kind of across the EV space, and Tesla is just getting caught up in that. So will xAI really pull them out of that? I don't see how that can improve their car business. How does AI really impact their car business, especially an AI company that's only been around a year? So I see this as just another one of Elon's ploys to kind of raise more money, do a related party transaction to kind of help out his business empire, which he's done many, many times before. Right? Starlink is advertised on Twitter, for example. So this is a common occurrence within the Elon universe, but I don't think it's going to really drive much business and long-term growth for Tesla. Now, the next Invest Talk, we'll look into this story. Budgeting for retirement. Don't forget healthcare hidden costs. We'll look at that story tomorrow, but for now, I'm Justin Klein and ready to take your calls at 888-99-CHART. Now let's take a look at the market performance for today. It was a bit of a mixed bag. You had small caps down for the first time in a while, but they underperformed kind of the broader index. And the S&P was up slightly, up 4 points, less than 0.1%. Mid caps were positive. They actually did the best, up about 17 basis points there. So you're in the midst of earnings season. You're going to get some big pops and some big drops. And I don't think the market moved a whole lot because tomorrow is the Fed meeting. And what will be important is whether they hint at a September rate cut. It's very unlikely, despite some Fed speak over the weekend, mainly from Jim Dudley, I believe, a former Fed chair. And he said they should cut now, but the market is not pricing that in. The market is clearly pricing in a Fed rate cut in September. But as usual, the market or the Fed likes to signal many, many weeks and months in advance that rate cut is coming. They do not like to surprise the market because they don't want volatility that could feed on itself, shall we say. And so having a slow, gradual pricing in of a policy shift is what they prefer. And that is likely what you'll get on Wednesday. What will be even more important is, what are the longer term dot plots? What do they think rates will be at the end of the year? Are they looking at another rate cut, maybe in November or December? Or, what about 2025? Do they think this is going to be an extended rate cutting cycle that starts in September? Or is it more of, hey, let's do a couple of cuts and wait and see? And a lot of that will depend, messaging will play into currency markets. And as I'll talk about later in the show, that's becoming more and more important and starting to feed into equity prices, especially the big tech names. So that's what you're seeing today in markets is mainly focusing on the earnings pictures out there. McDonald's was, I think, the biggest one that had earnings. It was up on those earnings, but it had been down into the earnings. So it was kind of expected to be relatively poor, and McDonald's got a bit of a bounce, even though their earnings fell 6%. So that's a good example of, hey, markets kind of price in these type of events. So once again, mixed bag on the day. The dollar didn't really move much. Let's see, gold was down slightly, but relatively flat. So frankly, a boring day as we head into Fed week, and we get a lot more earnings announcements later this week. I think Apple's this week. I believe Amazon, NVIDIA, I believe, is next week. Microsoft is this week. So there are some big tech names that will certainly could have a large influence on the market as a whole. Let's tackle our first caller question now.
Hi, I just want to get your take on Take-Two Interactive. I bought into this about 6 months ago, and I'm wondering if this is now a good time to add a little bit more to my portfolio. I know they have the new Grand Theft Auto game coming out. I believe it's the second quarter of 2025. So again, just wondering what your thoughts are, and if this is a good place to add more. Thanks.
All right, looking at Take-Two Interactive, $26 billion market cap. And, they've been struggling for a few years now. They did very well during the pandemic, like most kind of home entertainment type of businesses, which obviously gaming is one of those. But since then, since 2021, earnings have been falling. It was $6.92 in 2021, then down 27% in 2022 to $5.06. Then now down another 31% last year at $3.49, and then full year 2024, which actually is in the books for them. Some companies their fiscal year end doesn't line up with the calendar, and that's the case for Take-Two. That was down 30% last year, $2.46. So it's to bounce back a tad this year. So that's the positive. It's kind of leveled out here. But if you're going to only earn $2.59, that's not that great. But next year, supposed to earn $7.47. Now, if you base it on that, right, the new Grand Theft Auto, as the caller asked about, then suddenly it looks okay, right? You look at $150 stock, it's around a 20 market multiple, and that would be just fine. Okay. Now, if we look at the profitability, which let me pull that up here. TTWO is the symbol, if anybody was wondering. Let's see here. No dividend. Current return on equity is pretty bad, negative 46%. But, that's the lowest it's been in a long time. And, your hope is that it gets back to that roughly mid to high teens return on equity like it had before. But this is, it's a very cyclical business. It needs to develop its, Grand Theft Auto, and that's their flagship. But it needs to update regularly, and that's very capital intensive. So it's very up and down, and that's what I don't love about that business. Is that it just requires so much investment, and how long can they ride that train, right? Grand Theft Auto has been around a long time, but does another company come in and create something very similar that maybe catches the attention of their customers? That's the big worry here. So I don't really love it. Yes, you're playing Take-Two, your Grand Theft Auto launch, but the market knows that. You're not finding out anything new that the market doesn't already know. It's just a matter of, will the sales outpace market expectations, or will they underwhelm? And that's not really a bet that, I'm going to really invest in, right? That's what this is about, investing in a business. And I wouldn't be jumping on this, not at these valuations, not with the technicals. They don't look too hot either. So I'm going to pass on Take-Two Interactive. Now, we have a lot of ground to cover over the next 45 minutes. The yen carry trade. This is something I covered on my market analysis over the weekend over on our YouTube channel. So you probably want to go check that out. It's titled "The Yen Kneecaps the NASDAQ." So I'm going to go over that a bit on today's show and just unpack that story and how important this trade is to current market direction. Because clearly there's a correlation, and we want to look at that. And then lastly, new rules coming out of the IRS on inherited retirement accounts. There's been a little lack of clarity, and the IRS gave some clarity after a 2019 change of the law and change of the rules. So we'll look at that story as well. But ultimately, this is about you and your questions, things that are on your mind. And we will get to voice bank questions. One is on Lumen Technologies, and the other is on interest rates. But We also have questions submitted via the comment section over on our YouTube channel. And of course, once again, your live calls at 888-99-CHART. Now we're going to do a short break. Please remember, you can call anytime and leave your question on the InvestTalk voice bank. And if you're listening via the live stream or on AM 1220 radio in Silicon Valley area, you can call right now at 888-99-CHART. Now let's swing back to the InvestTalk voice bank for a question that came in earlier at 888-99-CHART.
Hey guys, this is Kevin calling from Southern California. I have a question about interest rates and yields and bonds. You've been saying that you expect a rate cut this year, but also that it's not the right time to buy longer term treasuries because in the long run that rates are going to continue going up. So I'm wondering, if the Fed starts cutting rates this year, what will be the driver to bring them to raise rates above the level that it is now, such that you think that, the 10-year might end up above the level that it is right now? Trying to get your thoughts on this subject. Forward to hearing your thoughts again, and thank you as always.
Now, this is pretty simple because when you hear the Fed cutting rates, frankly, that's become a sideshow, and that is only the short end, okay? Remember, that's the Fed funds rate. That's your what banks are lending to each other on a very day-to-day basis, very, 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 very short term, okay? And that's typically what drives short-term treasury rates, 1, 3, 6 month type of rates, okay? So when you hear the Fed raising or lowering rates, that's what we're talking about. Now, when you're talking about longer dated issues, 5-year, 10-year, 20-year, 30-year bonds, that suddenly is can be influenced by the Fed, but mainly through the QE or QT channel, so quantitative easing, quantitative tightening. So are they buying more bonds? Are they selling more bonds? Right now they're doing more QT, and that is more on the mortgage-backed securities. So they're not trying to push. They're actually adding to their holdings of longer dated bonds, 5+ years. So that's helping keeping rates relatively contained. But longer term bonds are really governed by market expectations, as well as treasury action as well. So this is a very complicated game here. But long-term bonds, I think, are going to continue to grind higher, even though short-term bonds might rise and fall based on Fed funds moves. Okay, so hopefully that answered your question. Let's go down to San Diego and talk to Mark, looking at ConocoPhillips. You own it, Mark, or looking to buy it?
Well, I got some energy exposure, but I noticed it's come down, so I was wondering if it's a good buying opportunity.
Yeah, we like ConocoPhillips. We actually own this for clients. It's been in a trading range here between about 105 and 132 or so, and it has down to the lower end of that range, about 109 today. But it is a business that continues to throw off very good cash flow. And obviously it's going to be correlated with oil and gas prices, but it's globally diversified, not just here in the United States, but they have huge projects in places like Norway, in the Asia Pacific region, as well as the Middle East. And so, it's $127 billion market cap. So, it's not Exxon and Chevron, but, it's kind of that next tier below. So a lot of great efficiencies, a lot of great assets that they own. But obviously oil prices have been kind of choppy here in the mid 70s to low 80s range. And the question is, can it get some traction to the upside? And obviously, if it does, ConocoPhillips will follow. But, from a valuation perspective, enterprise value to EBITDA is right around 5.5, which isn't the lowest in the industry, but due to their quality and their cash flow, we think it's plenty low. Return equity 22%, and they're buying back shares. So, we're fans of ConocoPhillips down, in this 105 to 110 level.
Okay, thank you.
Thanks for the call. Now let's go talk about the yen carry trade. The yen carry trade, and this is something I talked about on my YouTube video over the weekend. And as of late, the yen has been up for about 3 straight weeks. Okay. And there's a few reasons for that. Number one is the Fed is talking about starting a rate cutting cycle. Okay. So the yen has been historically weak, and its downtrend really took off once the Fed started a rate hiking cycle in early 2022. And the Japanese central bank, JGB, did not raise rates, to counteract what the whole world was doing, not just the US, but the ECB as well, and many other central banks, to fight inflation. And a big reason for that is they've been at negative rates for a long time, and they have a ton of debt. You think we have a lot of debt? Their debt to GDP ratio is more than double ours. Okay. So they've done a lot of quantitative easing and had very loose monetary policy for a long period of time. But the rest of the world had similar loose policy, right? We were near zero as well, right? We were going to go to negative territory, but we were in the ballpark. Now it's very far away. You can get a 10-year treasury, a short-term treasury at 5.25% right now, whereas Japanese bonds are yielding still near zero. Now, what's happening here is they're talking about raising that and stopping bond buying and actually tightening policy, whereas we are entering an easing cycle. And so what you're seeing now is the yen strengthen as that gap is expected to shrink between the yen yield and treasury yields. Okay. And what happens in times like this, where the borrowing costs in Japan are so low, and this has been something that's going on for a long period of time, is what is called the yen carry trade. You borrow in Japanese currency, in the yen, and you go and buy higher yielding assets abroad. Now, typically that might be a treasury, but doesn't mean that you have to only invest in treasuries. You can also invest in things that maybe are yielding better than that, like the returns on tech stocks, equities in the United States, which have been in a strong uptrend as of late. But what happens is if the yen appreciates too much, suddenly that eats into the returns on these other assets. But you don't want to be last to get out of this trade. And so what's happened recently is that those that are the most skittish are starting to sell and unwind this yen carry trade. And so it's not a coincidence that the yen is up a lot and tech stocks are now down a lot. Okay. And the dollar has dropped more than 5% against the yen since July 11th. And that's a big change from where we've been over the past couple of years, where the yen is just ground lower compared to the dollar because of that rate differential. You add on top of that, presidential candidate Donald Trump reluctant to maybe support Taiwan. You also have AI hype that is starting to come unwound with the Goldman Sachs report a few weeks ago that there isn't enough meat there to support these valuations. And you get all of these factors combining, and you're seeing the tech-heavy NASDAQ down 7% over the same period that the dollar decline against the yen started. So right there, that's a 12% difference, 7% drop in the NASDAQ and a 5% increase in the yen. And suddenly you potentially get short covering in the yen and selling. In order to finance that short covering, you have to sell your assets that you've bought. And this is a common, very popular practice among hedge funds. And so this hedge fund trade is starting to have a big impact on markets. And I think we're very early in this game. And this has happened before. This is happening relatively slowly, but back in 2015, the Swiss franc moved up dramatically when the Swiss central bank gave up on efforts to keep their currency low. And the Swiss franc appreciated dramatically, swiftly. And what happened then? The popular trades then were down 5% in the next few days as that trade unwound. So that's what is happening in markets. That is a big, big factor in why you're seeing tech stocks down, is that shift in Fed policy, shift in the Japanese central bank policy. And you must continue to watch this because as long as the yen continues to strengthen, you're likely to see weakness in tech stocks. Now, I hope you've been telling your friends that the InvestTalk audio podcast is also available in video form over on our YouTube channel. And we get questions submitted via the comment section over there. And let's answer one of those right now. Gabriel Garza says, can you please give me your evaluation on SYK, Stryker? I've owned it for a while now and seeing if you see any revenue or earnings growth. Thanks a lot. Thank for all you do for the people. It's highly appreciated. No problem. Now, Stryker, this is in the medical device space. It is a large name. The market cap is $127 billion, so definitely a large cap. It is trading at pretty high multiple, 30 times earnings. Supposed to earn about $12 this year, $13 and change next year. So even if you go based on forward-looking earnings, you're talking about a high 20s multiple. And those estimates for this year and next year continue to come down. And so that would be a bit of a worry for me, is that this is trading at elevated multiples compared to its history. Now, it's a good company. Its relative strength is good, 60, solid. So above average, not the best out there, but above average. Return on equity is at 18, and the 5-year average is about 16. And historically, if you go back to the 90s, the return on equity is in the high teens, which is what you want to see. High teens or better. That's a great business. Good balance sheet. But once again, high multiples. Enterprise value to EBITDA is 26. We talked about ConocoPhillips, the last call. That was at 5.5. This is at 26.5. Now, obviously, their business is more consistent and it's going to trade at a higher multiple. That's understandable. But 26 times, that's much higher than, it historically averages. Okay. So I do think it's a bit expensive. The technicals are weakening here. Remember, this is a large cap name. So could this be caught up in the yen carry trade unwind? I certainly think that's possible. Now, it's not in the epicenter, but it could see some earthquakes, some after shocks in a name like this. So I would be a bit wary about adding here. This would probably be a place I would rebalance. I wouldn't sell it all. I would say, okay, how much of my portfolio is it? What is my target goal for this particular position? And rebalance, sell a little bit of it and try to get back into a more reasonable allocation after this recent run. So that's how I handle Stryker. Good business, but I don't love the valuation. I don't love the earnings estimate downtrend, as well as the technicals are starting to weaken as well. So that is Stryker. SYK is the symbol. Now, 2024 is moving fast, and the proof is that we are well into the third quarter. We're just a couple days away from the end of the 7th month of the year, and entering the warmest time of the year. Not just for the weather, but for markets. August and September are historically volatile, and you're starting to get a little bit of that volatility early. And so the question is for you is, are you prepared? Did you buy into the AI hype, and is that momentum fading? Do you have too much exposure there? Do you have enough exposure to the sectors that are going to benefit from higher debt levels from government, monetization of that debt, weaker dollar, higher inflation, higher interest rates long term, yet maybe a rate cutting cycle near term? All of this, it gets complicated. So if you need help, I encourage you to reach out to my company, KAPP Financial, where we practice parallel investing, which means we invest right alongside our clients. And we operate with the same philosophy, which is independent thinking and shared success. And our goal, both on and off air, is to give you unbiased guidance. That's what we do. And we provide a free portfolio review assessment via telephone or Zoom. So send us a message. Just head over to investtalk.com and click on the portfolio review button in the top right-hand part of the screen. Let's go talk to Robert in Pleasanton, looking at Target. Do you own it or looking to buy it?
I'm thinking about buying it. The numbers look pretty good to me. I know they've certainly had their challenges over the last couple of years, but just want to get your thoughts on whether or not you think this is a good time to maybe jump into it.
Well, Target's been down since late 2021. A couple of reasons. People stopped buying things as much, right? Everybody was buying physical goods in 2020 and 2021 because they couldn't go out and do a lot. And Target benefited dramatically from that. In 2022, they made $13.56. But that fell 56% the next year. Part of it was that lack of buying physical goods. But the other was they had that kind of political issue. I forget the exact details of it. But there was, in many parts of the country, a boycott against some of the, say, politically charged things that they were doing from a marketing perspective. Now, the positive here is that they've begun to put that in the rearview mirror. It's not, at the height of controversy at the current time anymore, and their business is slowly improving. It was up 49%. Earnings were up 49% last year to $8.94. Supposed to be $9.32 this year, up 4%, and then 12% increase next year. 3% dividend yields. They're obviously a solid business, still very profitable. Return on equity at 32%. So I like what you're looking at. Quality name here. But it's not that cheap, considering that lower level of earnings. But I like what what I'm seeing in the trajectory of the business, frankly. So I'm going to give this a mild thumbs up. I think that one issue you have to consider is the economy does continue to weaken a bit, even though consumer balance sheets are relatively strong. So I don't think we're going into a major recession or anything near term. So I don't mind it. The technicals are okay. You'd have to have a really long-term time horizon with this because there's no guarantee that it's bottomed after this recent pullback. So if you're looking for a trade, I'd be patient on it. As a long-term hold, I would give Target a thumbs up. Thanks for the call. Actually, let me get to one last question submitted via our YouTube channel. Noah RXX says, I'm looking at Schlumberger. And this is a name that we used to own for clients, but we actually traded out of it. The service side of the oil business is challenging, and this stock just kind of lost momentum. So we moved out of it, and I would continue to keep this on the sideline of your portfolio as well. Now, this is InvestTalk. I'm Justin Klein, and we have one goal each and every weekday, and that's help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART.
Good morning, Justin and Luke. Calling from Iowa, looking at Intel Corp, INTC. I know they got earnings coming up here, I think, next week. So just kind of wondering if maybe you thought this is a good buy point or where you think a good buy point is for this company. Kind of been at these levels for a while, up and down, but you give us a little more insight on that one and see where a good buy point to come in on that one is would be great. Appreciate all the work you guys do, and thank you.
All right, looking at Intel, and you're correct, they do have earnings later this week, and I do think this is a good risk versus reward down here. Now, it's fallen from 50 back in the beginning of the year down to around $30 per share today. And that's because earnings growth has come in for this year. Expectations have come in for this year and next year. But they do have a new AI chip that is supposed to be pretty competitive with some of NVIDIA's offerings. So we'll see that now that I believe that's being launched in the third quarter. So we'll see what type of commentary they have around that. And I think that is what would drive Intel much higher. If they can credibly stamp their entrance into the AI hardware race, then I think this could easily get a large boost. But that's the risk. That's the risk you take. Intel obviously has a good brand. but it's been eroded by AMD and NVIDIA over the last 5-10 years or so. But they now, one of the big reasons is because they had a CFO as their CEO, and they've changed their CEO. But that change, especially in the tech field, takes some time to reorient to their product base in order to keep up with their competitors. And so it's kind of a show me quarter. I think this year, this quarter and next. But I do think it's a good risk versus reward right now. Thanks for the call. Now, lastly, let's cover a rule that came out in 2019 in regards to inherited IRAs. And it created a lot of confusion. Basically, it said that people who inherit an IRA have to take the money out within 10 years. But it did not say whether you could take that money out all in year 10 or you had to take an RMD each year. But the IRS recently clarified the rule, and they did say that the money has to come out each year for many of the heirs. Now, this does not include spouses. These are heirs. So, and it applies to those that inherited an account since 2020 and beyond. Okay, and a lot of those people were in limbo trying to figure out what are the rules. And starting next year, they will start to enforce these rules. Now, this is only the case if the person that passed away was over the RMD age of 73. Okay, so if they were below that, then that's a different story. Then the money is taken out based on life expectancy of the person that is inheriting it. Okay, and that's in line with what it had been before. But this rule change was basically to say you can't have an IRA that was inherited, and the government wants their money. Okay, and so that suddenly the government thought they were going to get these tax payments based on this person taking RMDs, but they pass away, and it goes on to the next of kin, and suddenly those tax payments are spread out. Okay, so there are RMDs that are going to need to be taken each year. Okay, now a good example is if say there's a $100,000 IRA in 2020, and there was no distributions between 2021 and 2024 because of in limbo, right? They were in limbo. And it grew, if it returned 5%, it grew to about $121,550. And in 2025, the RMD will be $4,000. Now that's a small amount compared to $121,000, which means that potentially there could be a balloon payment at the end of that could impact your taxes in a big, big way. If you just did the minimum distribution each year and waited to the very end, you could be hit with a big, $150,000+ distribution, and that could bump you in a higher tax bracket, and you don't want to do that. So make sure that if you get an inherited IRA, you know the rules. It's a little more clear now, and you start to take that out strategically over the 10 years. Well, that about does it. I'm Justin Klein. It completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find on iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And head over to our YouTube channel to search InvestTalk and subscribe. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.